Hello, everyone. I'm Matt Clark, research analyst for Money and Markets with your latest Bull and the Bear podcast. Glad you're joining us on this kind of weekend edition. We've got a lot of stuff to go over, and I want to jump right to it before I go into a spiel about how you can listen and all that stuff. Today, I want to take a focus on technology, but be a little more specific. Because technology development has kind of been slow in the last couple months. You probably can thank coronavirus for that. Supply chains are not operating as they usually are. More people are working remotely, things like that. So technology development really isn't going full bore. And it's hindered development of things like artificial intelligence, robotics, even 5G technology has been slow to roll out. But it hasn't stopped companies from developing that, the companies that develop that technology from thriving, actually. If you look at the Global Robotics and Automation ETF, it trades on the stock exchange under ROBO, aptly named. It's up 74% since hitting a March low. It's dipped a little bit in late September, but it's gone up about 10% since then to its current price, indicating that there is a possible upswing in the offing. The ETF holds companies like NVIDIA. Everyone's heard of NVIDIA. You've got Rockwell Automation, which if you're not familiar, they are a company that does a lot of PLC programming on automation for robotics. And also semiconductor powerhouse Qualcomm is also in that ETF. And I want to pull two stocks that are listed in that specific ETF. And they're in other robotics and automation ETFs. But I thought of this one specifically. And I want to bring in Money Markets contributor Charles Sizemore, as well as Chief Investment Strategist Adam O'Dell. We'll kind of round table these two stocks. So first off, welcome to those two. And let me jump right in and get to the two stocks we're going to discuss today. First off, the first company is a little bit, we were actually talking about this off air. It's a little bit, I don't want to say it's complicated to describe what they do, but basically they produce automatic test equipment for a lot of different industries. And these industries include semiconductors, industrial automation, wireless technology, and I have a sneaky suspicion Charles is going to drop a gangbuster reference in terms of what this company is here in just a minute. But to get more specific, the company had 1 year annual sales growth rate of 29.6%. It's got trailing 12-month sales of about $2.8 billion. Their sales increased from $2.1 billion in 2018 to $2.3 billion in 2019. Seems like things might be slowing just a bit in 2020, but not too much. The company has a 3-year annual earnings per share growth rate of 149.3%, and earnings have blown away Wall Street expectations in each of the last 5 quarters. The company here is Teradyne Incorporated. It trades on the Nasdaq under the ticker symbol TER. And I'll first start with Charles Sizemore. First off, Charles, welcome. And Teradyne's had a nice run here of late in terms of sales and in terms of earnings per share. But are they a company that worth, if you're an investor looking at robotics, industrial automation, artificial intelligence, are they a company worth looking at today?
I would say so. So I'm going to give this a buy. I would put a caveat on that given that this is a pretty volatile stock, I would say maybe keep your position size a little bit smaller than usual. You probably shouldn't put the same amount into a stock like this that you would put into, say Johnson & Johnson or something more conservative. That's okay. I mean, position sizing is a part of investing. And I would say this is a good company. It's one that I might make a slightly smaller position. There is some interesting backstory on this, or probably backstory is the wrong word, but sort of a macro story, if you will. Automation has been a trend since the Industrial Revolution, of course. And these guys are part of that. Now, what we've seen in different parts of the world, less here, more in Europe and Japan, is that as societies age, automation becomes a lot more important. I don't have to really go into a lot of detail why. It's pretty obvious. When you have a shrinking workforce and aging workforce, it's nice to replace some of that labor with machines. Now, there's also sort of a pandemic element here as well. Companies have realized how sensitive their models can be to disruption. People can get sick. People can be locked at home, but they can't leave their house. People can be stuck in airports, whatever. Whereas machines don't. Machines just keep clicking along. And our joke off air was that I don't remember the name of the company that made Skynet in the Terminator, but I swear it was Teradyne or something that sounded a lot like that. So this is also the company that is eventually building the doom of mankind. So you can invest in that as well. But no, I do think this is the stock has some good tailwinds supporting it. Again, I would say, maybe keep your position sizes smaller than usual, but overall, good stock.
Okay. And yeah, that was it. The Skynet reference in terms of Terminator. That's great. Anytime we can drop a movie reference, I think you've had Star Trek and now it's Terminator. I think people
just make the list of science fiction. We'll get through them all.
Viewers and listeners are starting to get an idea of where your head's at, which is both okay.
It's a dark place.
And maybe
dark place.
Now I want to bring in Chief Investment Strategist Adam O'Dell. Adam, you look at the factors here in terms of it's price to ratios, it's return ons. Teradyne is actually positioned very well, especially compared to the rest of the industry. What is your thought on Teradyne?
Yeah, so as far as some of the factors or the metrics that you mentioned that would fall into the 6 factors that I look at momentum, size, volatility, value, quality, and growth as part of my green zone 6-factor stock ranking model. Teradyne really earns the highest scores on quality and growth. So as you mentioned, they have double-digit growth rates in revenue and sales, and then also I think their net profit margins in like the mid-20s, like 24, 25%. So it's quite a rich profit margin there. That tells us they have something of a moat in their business that they can charge higher premiums, and if they keep their costs low, they keep a good percentage of the revenue there. So it really gets good scores on quality and growth. As far as value, it's a bit overpriced. It ranks 39 out of 100 on my value score, meaning that it's a little bit below average, but not too extreme. As far as volatility, it's interesting because Charles mentioned that it is a more volatile stock than it is, but Teradyne earns a higher volatility score, meaning that it's a less volatile stock than the next stock we're going to talk about. And that's partly because even though it has a higher beta, meaning that it tends to be more volatile and more correlated to the bullish market, to the passive bull market. And my volatility score also looks at risk-adjusted returns. So basically it says that for the given amount of return that you've gotten from this stock in the past, how much volatility has it suffered through. So on that basis, where even though you suffer through some volatility, the Sharpe ratio and the Sortino ratio, which are 2 metrics I look at, they kind of quantify the question, well, is it worth that volatility? For that level of volatility, am I getting market-beating returns that compensate or more than compensate for that volatility? And on that measure, Teradyne rates a 69 out of 100, so it's a pretty high score for a volatile stock. It's certainly not small. It's a small company. It's rather large at 14 billion, a little bit over 14 billion. But it's got good momentum. Overall, it rates very highly. Rates 84 out of 100 overall on my 6-factor model. I also like the technicals. Just looking at the broad technicals, it's in an uptrend. It's already bested its earlier highs after the Corona crash. It had a pullback in September to kind of test those highs, and it held at those highs and have now traded up to new highs right now. So even on a kind of a purely technical basis, I think Teradyne's a pretty good play. As far as their business, I'm bullish on industrial automation, and I think the fact that they are kind of something of a picks and shovels play, meaning that they don't produce one particular product, but they kind of provide a service of testing and making sure everything's running properly on a number of different products. So I think that's kind of good that they have some diversification there. So overall, I'm pretty bullish on Teradyne.
I agree. I really like this company, and I don't know that there's necessarily one thing that stands out about it. Obviously, its metrics are solid. We look at Adam's ranking and his green zone rating system, and it's solid across the board just about. There's really there's a lot of things that come out to me that tell me this company has a lot of potential. I think moating was exactly the right word to use, Adam. I think that's exactly what this company has done, and I think it's going to allow them to profit and allow investors to profit at 12 months, 24 months down the road, especially as more nationwide 5G comes online across the globe, more industrial automation. I think the coronavirus is really pushing, companies like car companies, other mass producing companies into robotics a little bit more. And Teradyne can certainly stand to benefit from those kind of shifts. So all 3 of us agree Teradyne is a pretty solid buy at this point. This next company, however, has had it's had kind of an interesting story. It designs and builds and sells various robots to the consumer market, and they do this all around the world. They do it in the U.S., they do it in Europe, the Middle East, Africa. They have robots that will vacuum your floor. They have robots that will mow your lawn. They have robots that will actually teach children how to code on computer. Company has a 3-year annual sales growth rate of about 22.4%. Trailing 12-month sales was $1.3 billion. It's grown annual sales in each of the last 5 years. It has a 1-year annual earnings per share growth rate of 71%. The interesting thing here is that this company just recently reported earnings about a couple days ago, and its earnings were very strong. In fact, they actually beat Wall Street projections. However, the stock was beaten down pretty well in the day or so following its earnings, and it doesn't necessarily. You take earnings with a grain of salt a little bit. The misnomer is that if earnings are up, then the share price goes up. It doesn't always happen that way, and it didn't happen in the case of this company. The company here is iRobot Incorporated, and they trade on the Nasdaq under IRBT. First, I'll start with Charles. Charles, does that concern you at all in terms of when you see an earnings beat the way iRobot had? I think they beat earnings by 20 to 30%, I think, if I remember right. I'm not really sure on that exact, and then their stock actually takes a pretty solid downturn. Is that concerning at all?
It's not concerning. You have to know the sector you're in, and this is a sector that's been sort of subject to hype for years. I do like the stock. Their most iconic product is the Roomba vacuum cleaner that it just kind of cleans your house while you're at work. But this is a stock that's been sort of off and on faddish, where it's kind of, this is an investment fad this week, and then next week it's not. So it can be rather volatile. So I would not be necessarily concerned by that move, because it's not that unusual for this stock. When you get into a stock like this, you should expect volatility. So I would say, my advice on this is pretty similar to my advice on the last stock. It's a stock worth considering for sure, but I would definitely keep it. I would keep the position size a little bit smaller, because, well, you see, that's when you see one day movements like that, that's a lot less painful. This is a stock that can add to your long-term returns potentially, but it's not going to be those periodic downdrafts like that aren't going to be as painful if your position size is smaller. I've got a bigger picture on this. This was already a theme that made sense. The modern family is, two working spouses running around like crazy, trying to juggle work and getting kids to soccer practice and whatnot. No one has time to clean anymore, right? Life is too busy. And particularly these days, post-pandemic, people are a little bit less comfortable having someone in their house, having a housekeeper to clean for them. So something like a Roomba is actually really good to just do some of the basic cleaning for you, and not have to have people outside your household in the house. It was already this was already a trend pre-pandemic. It just the need for help and limited human labor. But post-pandemic, it's all the more useful. So I think this is a great theme stock. I think this company is going to be with us for a long time. I think acceptance of their products. Right now, it's still kind of a novelty to have a robotic vacuum cleaner that just cleans while you're at work. I think in the years ahead, that's just going to be normal. It's just going to be expected. Everyone will have that. It's like the Jetsons. See, another pop culture reference here. Not a movie, though. This is a 1950s cartoon. But the Jetsons, the house just runs itself, right? That's the future, and I think this stock is part of that future.
Interesting. And I believe the Jetsons did actually have a movie. So okay. So your movie references aren't lost. Adam, I'll ask you the same question. Are you concerned with a 1 or 2 or 3 day move when earnings are high and the shares actually shift downward in price?
Let me reframe it. I guess I'm not surprised. There's kind of this misnomer, this simple logic that's used by a lot of investors that says, well, if you go into earnings and if you think that the company is going to beat earnings, then that guarantees, or it means it's highly likely that once you hear that beat, then you're going to get a strong pop higher in the stock. And let's say you want to buy call options ahead of the earnings and you think that they're going to beat expectations and you're going to get a huge pop in that call option. There's a number of problems with that logic. First of all, you have to guess correctly, or you have to forecast or predict correctly whether the company is going to beat. And then they have a number of metrics that they could beat or miss on. There's top line revenue, there's bottom line profits. Adding a second layer to that, you have to determine whether that expectation is already priced into the stock. So if everybody's already expecting the stock to beat revenue expectations or earnings, and that happens, well, then there's no really more upward movement in the stock because that's already been priced in. The third order of that is you have to realize the companies then revise their future expectations. So they could beat earnings for the previous quarter, but then lower their forecasted expectations for the following part of the fiscal year. So it's a third layer. And then the fourth layer is just how does sentiment change? I mean, sometimes you see a stock that beats on everything, and then investors were just greedy and they think that they should have beaten by a wider margin. So then sentiment sours and the stock sells off. The other problem with, just while I'm on this rant, is that buying options ahead of an earnings announcement is that you think it's just a directional trade. You think, well, if they get a beat and then the stock goes higher, then my call option, which is a bullish play, is going to pop higher. But oftentimes, what a lot of novice investors don't realize is that there's a lot of volatility price baked into that option. So when you buy the option for, say, $5 a contract or $500 a contract, if a large portion of that is high expected volatility, and then after the earnings announcement comes out and volatility goes down because now there's less uncertainty, there's a more certain future. Often you can get the directional move right and still lose money on the option because you have the volatility component of that pricing go down. So, there's a lot of details. If you don't follow along, that's fine. But the point is that at the end of the day, in simple terms, is a lot trickier to trade an earnings announcement than most people think. So am I surprised that iRobot beat most expectations and the stock traded down? No, not really surprised by that. As far as, longer term, it's probably just a short-term consideration. Longer term, I have real mixed feelings with this stock because it rates very highly on my 6-factor model. It rates like a 96 out of 100. Gets high quality scores, high growth scores, average value, average volatility, decent momentum. It actually gets a pretty good size score because it's just over the $2 billion small cap category. But the problem I have with this stock is kind of twofold. One, as Charles mentioned, it was a very fat stock in recent years. And so it basically, at the beginning of this bull market in 2009, went from under $10 all the way up to $110. So it increased 11x. And that last part of the move in 2017 was parabolic. Since then, the stock has really been choppy. It's made some dramatic swings higher and lower. So during the Corona crash, it was as low as its 2016 prices. So it's recovered a good bit since then, but it still hasn't recovered to its 2019 peak at about 130. It's right now at 85. So for me, it's just a really choppy stock. And I don't know, this may be a bias that is working against me, but I have a hard time. I don't personally see the value in buying the robot vacuum cleaner. I clean our house. I use a cordless vacuum. So that to me is a nice feature, to not to have the cord, but to have this little robot running around and at my feet. I don't necessarily see the value in that. So I know that they are coming out with other products. I do believe in automation, and particularly industrial automation. But as far as this very niche product, I think it's certainly a fad, and maybe a lot of people will have it. But for me, it's kind of hard to buy this stock based on such a particular niche product. And certainly at these prices, so I'd probably be a pass even.
Okay. I really thought about this a lot, and I thought about this overnight. I thought about it this morning before we went on, and because this is the one I was really kind of tossed up about. I just couldn't make a determination on whether I liked it or not. Obviously, with Adam's 6-factor green zone ratings system, it does rank very high. I mean, it's very strong in growth, very strong in quality. You heard Adam talk about it. I mean, there's a lot of things moving in the right direction for iRobot in terms of Adam's system. You look at its price, its price to sales, price to cash flow, all beating the industry solidly, and its margins are good. Its net margin right now is about 11%. Its operating margin is about the same, about 11%. The thing for me is I looked at, the company's got about $52 million in debt, but they've got about $357 million in cash. Their sales have gone up each of the last 5 years. And I think that's going to continue. I think that, iRobot it may be a fad, and I agree with that. It is. I actually want one, but because I've got vacuum with a cord and all that good stuff. So you're actually a step ahead of me there, Adam, in terms of what you're using to clean the house. But I think there's going to be there's going to be a market here. And I think if this company can be successful in branding and creating other products outside of just a vacuum cleaner, I think if they're coding software and they're coding robotics for children, I think is fantastic. I love that. The mowing thing maybe a little bit slow to come up, but I think if they can be
do you really trust something with like whirling blades to just go by itself with no human intervention? That's
I live in an apartment complex, so I really don't have to worry about that. But I think that's why it's going to be a little slow to take off. It works under the same premise as the Roomba in terms of it maps it out and then just goes up and down and up and down and up and down. And it works, but
I get it in theory, but whirling sharp blades,
whirling lawnmower blades.
It just seems like robotic Legion of Doom or something. I don't know. I'm not good with this.
Brought to you by Teradyne, who brings you Skynet.
Have your lawyer read the user agreement very closely.
Exactly, for sure. But so I guess if I had to break a tie here, I would probably be with Charles on this. I would keep the position small, just because it is an extremely choppy stock. I think it can reach its 2016 highs. It's going to take a lot of time to get there. It's not going to happen overnight. I think it's going to take. It could be 2, 3, 4 years before it actually reaches that high again. So if you're going to get into iRobot, I would probably say keep a very minimal position in terms of that. If you're going between the two, I'd say Teradyne is probably your better bet. So to recap, we're all three pretty strong on Teradyne. Charles and I are good with iRobot on a limited basis, and Adam is what I'm hearing is a soft pass.
Soft pass, yeah. And I do have one quick note at the end here, just
sure.
20 seconds.
Yeah,
and
absolutely.
That's if you don't want to bet on an individual stock within automation, but you like the industry, Matt, you were really great to point out one ETF. I'm a big fan of these industry disruptor ETFs, industries that are kind of up and coming.
Absolutely.
So you don't have to pick the winner. ROBO is the one that you mentioned.
Yeah.
I just want to plug another one. It's Global X. Is the fund company, and they have one called BOTS. So it's B as in boy, O, T as in Tom, Z as in Zulu.
Exactly.
So that's another one to check out.
And these are great ways to, again, like Adam said, if you're not looking to invest specifically in a company, but you still like the overall sector, because it is a strong sector. Again, talked about it, Robo, the ETF Robo, 74% up since its March lows, and it's still trending higher even after a short, about a 2 or 3 day dip in September, back up 10% off of that. So that is another way to really look at that if you're looking at the industry as a whole. So that's going to wrap it up for us on this episode of The Bull and the Bear. It is actually our 51st episode, so I don't know if there's a milestone in there somewhere, but we had our 50th episode earlier this week, so I hope you listened. If you do want to listen to The Bull and the Bear, you can do so on our YouTube channel. Just go to youtube.com, type in Money Markets, find the green Bull and the Bear, and click that. Make sure you subscribe, hit the bell, you get notified every time we put out a video. We're also on various podcast indicators. If maybe audio is not your thing, and maybe Charles is just not as strikingly handsome as you once thought, and you want to do an audio version instead, hey, you went with Terminator, I've got to come back at you somehow. So maybe audio is your way to go, then you can listen to us on Apple Podcasts, Google Podcasts. We're also on iHeartRadio, Spotify, and now on Amazon. So you have a wide array of places you can listen. If you have a comment, question, concern, maybe a stock or a sector you'd like us to look at, email us at thebullandthebear@moneyandmarkets.com. And we've got much more coming up. We've had the marijuana market update already. We've got our week ahead that comes out at the end of the weekend, plus much more. Team and I we're sitting down. We're concocting new videos for you to put out on YouTube. So make sure you subscribe and get notified when we put those out. So for Money and Markets Chief Investment Strategist Adam O'Dell and contributor Charles Sizemore, I am Money and Markets Research Analyst Matt Clark, your host of The Bull and the Bear, as well as the marijuana market update and the week ahead. And until we talk next time, everyone, safe trading.